Hey everybody, Courtney Smith here with a quick video on why I didn't buy GME and I missed out on all these incredible profits. I hate not making a lot of money, but what I hate more is losing money. It's against my religion. It's the 11th commandment, thou shalt not lose money. So I thought I'd give you some explanation why I didn't make money in GME, which apparently everybody else in the world did except curmudgeons. Okay, I'm not a curmudgeon. Here's my method that I use to identify stocks. The first thing is I look at the overall context. I want to know what's happening with the market as a whole before I look at a specific stock. So I'm going to look at is the stock market in a bull market, bear market, sideways market? I'm going to look at seasonality. I'm a big player in seasonality. I wrote my first book in 1979 about seasonality, so I've been doing it for a long time. And monetary policy, I live and breathe monetary policy. Give me a good M1 any day. Then you have to start looking at the stock. So you look at I'm looking for high earnings growth. That's a big factor in my methodology. But I'm also looking for cheap. It's got to be cheap. And then, of course, I look at the technicals. So I'm going to use some of the techniques that I teach in my courses. So technicals are going to basically get me involved. So even if the overall context is bullish and the fundamentals are bullish, but the technicals are bearish, I still won't get in. I want all three things in my favor. So the overall context, that's for another video. Technicals, another video. Let's take a look at the fundamental picture of GameStop, shall we? So everybody knows that this is a retail store chain of about 5,500 stores, so it's very, very large, and they basically rent video games. And they do other things as well. But you can see there's operates 5,500 GameStop, EB Games, Micromania, and Geek, I forget the name of it, but another store chain as well. So it's a big, big, big company for sure. But let's take a look at it. Over on the left-hand side of the chart, you see the earnings per share, which is very key to me. And you can see that in 2016, we had $3.89 per share. Then it dropped to $3.77. Then it dropped to $3.34. Is a pattern developing? Here's a company that's not doing really well. Then we go $2.14 in 2019, 2020, 22 cents. 2021, they're expected to lose $2.10. Now remember, a lot of places like California and New York are locked down, so you can't even go to the stores. But they're expected to rebound in 2022 to a loss of only 17 cents. So now I look at this and I say, well, it's really good that they're going to rebound from minus 210 to minus 17. That's a possibility that I'll buy a stock that does something like that. But not likely. Why don't I buy a stock that's actually making money and then accelerating dramatically from there, like up 50% or up 100%? In earnings, rather than finding a company that, if COVID keeps going, may lose another $2. In other words, the risk from a fundamental perspective is too high for me. Now, on the right-hand side, you see I've highlighted EPS rating. That 8 means that on a scale of 0 to 100, with the fastest growing companies at 100, 92% of companies in the market were growing earnings better than GameStop. Why do I want to buy the worst of the worst? My whole strategy is to buy the best of the best, the companies that are screaming in terms of their earnings. Now, this is a really interesting thing. Funds own 84% of GameStop. Now, what we saw is we saw a very short-term tactical situation this week in GME. What we had was a situation where there was more shares sold short than there were shares. Well, who owned the shares? Funds own the shares. Then we come and we see that the Reddit, the retail mob, decided to gang up on the short sellers and buy the stock. But they probably didn't buy the stock. They probably bought options because, as you can see, retail individuals didn't own the stock. It was funds that owned the stock. So that meant that there was very few shares available for the short sellers to buy back if they had to cover their shorts. So if a bunch of people gang up, or if one big person gangs up and buys a bunch of options on this, The options, as I explained in my video yesterday, the option buying will transfer into the stock buying through the market maker and jack up the price and cause a short squeeze. So that's not a fundamental factor. That's kind of a technical factor, but I found that quite interesting in terms of what happened this week. Return on equity, 2%. That's just terrible. That's terrible. I look for stocks that have a return on equity as high as possible, and I really don't buy stocks with less than a 15% return on equity, and I really prefer 20% or more. Why? Because remember that a return on equity, we give them $100 when we buy the stock. We say, here's $100, and then they're saying, we'll give you 2 cents back every year. What? I'm taking risk to earn 2%? That's not a good reflection on management or maybe the environment, the COVID environment, out of the control, obviously, of management. But nonetheless, return on equity over the long run is a good measure of how good management is. This year, we'll give them a pass because of COVID, but that's a terrible number. Most of my portfolio is going to be 20% plus return on equity. Now, this was interesting to me. Cash flow. You see, earnings are negative. But who cares? Earnings include a lot of non-cash items like depreciation and amortization, which they have a lot of, and we always want to look at earnings. But cash is cash is cash. And cash is what pays employees. It's what pays the rent. So cash flow is actually more important than earnings, and they have a positive cash flow of 179. Now, there is no PE on this stock because the price is so high and the earnings are negative. So there is no PE. But price to cash flow, most companies around 8, 9 times, something like that. This company is 182 times cash flow. Well, cash flow would have to go to, I don't know, $50 before this stock would be cheap. So I passed on it. Why do I want to buy a company that's so expensive? And then debt at 69%, that's not the worst I've ever seen. Lots of companies are zombie companies and have debt above 100% of their equity. But in this case, 69% in a COVID situation where it's hard for them to earn money. And in fact, they're losing money. You don't want to buy a company with, like I say, this is not super high debt, but with high debt and losing money. That's not a good thing. So as you can see from a fundamental perspective, this doesn't fit any of my criteria. My criteria works. And there are some times where there are special situations, and maybe GME is a special situation because the short sellers were so over short the stock that all it took was a match to light that on fire. But remember that this is not a long-term stock to hold because, well, you can see the fundamentals, not that great. Short-term play? Yeah, why not? Let's rock and roll. But generally speaking, I don't like to play them because they're so risky, okay? And I don't spend all day long reading Reddit subreddits, okay? I got things to do. But the technique that I've described to you of how I do the fundamentals and the whole structure of what I do works. Because in 2020, I had in my portfolio, and I publish a newsletter, so you can go back, you can actually see what my public track record is all the time. I had 6 of the top 10 performing stocks in the S&P 500. In 2019, I had 6 of the 10 best performing stocks in 2019. So this technique works, but it would never have gotten me into GME. So I thought it would be instructional to see how to build a long-term success, but sometimes it keeps you out of what was clearly an extraordinary situation, and I missed the trade. That's okay. There's always another one tomorrow. In 2021, I want to find 7 of the top 10 S&P stocks. I want to own them. All right, everybody. We'll talk to you later.